Hello everyone and welcome to Infinite Wealth Banking. My name is Rodney Brandt. I'll be your presenter today, and I want to tell you right from the start, we are going to give you a lot of information, and I mean a lot. In fact, it might just be overwhelming at times, so I recommend you get a pen and a piece of paper to take good notes. If you've got questions, write them down because you'll have an opportunity to ask them. And we want to make sure that you do get your questions answered. And today we are going to show you something we believe will really change the way you think about money. We're going to show you how to recoup the interest and finance charges that you pay every day, and you don't even think about it. It's just part of everyday life as far as most of us are concerned. We're going to show you how to control your debt instead of it controlling you, and how to build unlimited wealth at a guaranteed rate of return. You know, it seems today that there are few guarantees in life anymore, and wouldn't it give you great peace of mind and confidence if you could grow unlimited wealth at a guaranteed rate of return? Well, you can, and that's what we're going to show you today. I'm a marketer, and that's what I do for a living. I'm not a financial planner, and I talk to a lot of people. It's what I do. And as I talk to people, what I find is that people tend to fall into one of three categories. There are people who are doing very well financially. They're well prepared for retirement. They've got a great source of income. They've got a lot of good assets. They just want to protect what they have. Then there's a second group of people who are doing pretty well. They have an income. They're able to pay for all of the needs in their life, but they haven't put anything away for retirement, and they're just one work stoppage away from catastrophe. They're living paycheck to paycheck. They're making it, but if they get injured, or if they get their hours cut, or if they lose their job, they're going to be in a lot of trouble. And then there's a third category of people who are going to bed every night just praying for answers. How am I going to pay the mortgage? How am I going to make the car payment? How am I going to put food on the table? They're swimming in debt, they're spending beyond their means, and they feel trapped and they don't know what to do. Regardless of where you are, we believe you're going to be encouraged by what you see today, and I think there are answers here just waiting for you. Let's start by watching a short video. I never realized that lions hunt in a pretty simplistic way. I always assumed there was a strategy. They circle the prey, they look for the weakest one, they target that animal, and then they chase after it and corner it and kill it. Apparently, it's much more simple than that. All right, obviously we're having a little bit of fun. That's not how lions really hunt, but it's cute and it illustrates a point. I wanted you to see that antelope running into that tree because we're going to come back to it later in the presentation. And here's the parallel. We're just like that antelope when it comes to finances. There's one lone tree out on that desert, and wouldn't you know it, that antelope runs right into it, knocks itself out, and the lions can easily devour it. That's what we do when it comes to money. We're running into trees, knocking ourselves out because we're not paying attention to where we're going and what's happening to our money, and people can easily take money from us, and it doesn't have to be that way. So remember that antelope because we're going to revisit that. This begins with a willingness to unlearn. Think about why we do the things we do. It's because that's what we've been taught. That's what we learn. And we learn a lot of things from our parents. We learn how to do laundry, how to keep a checkbook, how to prepare meals, how to dress. All of these things as we're growing up, we learn, and that becomes a pattern in our life. But not everything we learn is in our best interest. John Maxwell is a noted author and leadership expert. He's studied people and leadership and human behavior for more than 40 years. He's written dozens of books. Here is one of our favorite quotes from one of his books. If you are too attached to your own thinking and how everything is done now, then nothing will change for the better. Think about that. How is it that we make improvements? We make improvements by changing the way we think. And once we change the way we think, then we can change our behaviors, and that changes our outcomes. If you are too attached to your own thinking and how everything is done now, then nothing will change for the better. We challenge you today to be willing to unlearn some of the things regarding money that you've been taught that are not in your best interest. Let's take a look at what happens to our money. Think of this illustration as a waterfall. Up here in the top corner, top left, you will see your income, and it flows downhill. And the concept here is your money has to flow into the next bucket in line until that bucket is full. Once that bucket is full and it holds all that it can hold, then your money can flow to the next bucket and then on to the next bucket. And there are 3 such buckets. The first is taxes. We all know that Uncle Sam is going to get what Uncle Sam is going to get. If you have a job, you likely have something called withholding. So payroll taxes are taken out, income taxes are taken out, and you never see them. So Uncle Sam always gets his money, and that's why the taxes bucket is first in line. Then we have our expenses bucket. That's all the stuff that we need to make our lives comfortable and secure. That's our mortgage, our cars, our credit cards, food, clothing, entertainment. That's all the stuff in our life. And then we have our savings, which typically is the last bucket in line because that's where we choose to put it. We have our 401k, our stocks, mutual funds, life insurance. Those are the ways that traditionally we save money. Now, once the current bucket in line fills up, as I explained earlier, the money flows to the next. For many of us, the savings bucket is last and it only gets the leftovers, and therefore when we reach retirement, we've got only a bucket full of pennies. Now, let's take a closer look at the buckets. Let's start with taxes. When we make money at our job or business, who always comes to visit? Uncle Sam, right? The IRS. We pay taxes on the money we make, that's called income tax. We pay taxes on the things we buy, that's called sales tax. On the things we own, that's called property tax. On the things we give away, that's called an estate tax. On the things we receive, that's called an inheritance tax. So think about it. We're taxed when we earn it, when we spend it, when we own it, and when we give it away. We pay more than 30 different taxes. On average, what percent of their income do Americans pay in taxes? If you combine your income tax, sales tax, property tax, all of those taxes that we all pay, well, that most of us pay, if you combine all of those, what is the average percent that Americans pay in taxes? I know it feels like 100. It's not quite that high, but it is significant. It's 40%. Our next bucket in line is expenses. Most of us have a home and a couple of cars and credit cards. Let's first of all talk about mortgages. The average length of a mortgage is 7.5 years. Now let's stop right there. Why is the average length of a mortgage only 7.5 years? Well, because when rates are down, we're encouraged to refinance. So we take our credit card debt and we roll it into our existing mortgage and we refinance and we get a lower rate and possibly a lower payment. So we refinance, or we might get a bigger house. So bigger house, different mortgage. Or we may move to another community or another state because of a job opportunity. So we're constantly seeing mortgages ending much sooner than what the term says. And here's the significance of that. Where do you suppose most of the interest is loaded into that contract? It's in the first several years. I was shocked the first time I looked closely at my mortgage statement. The house that I'm in now, the mortgage payment was $1,200. And after about a year, actually it was after I heard this concept that we're looking at today, I decided, I really need to take a look at what I'm paying on interest and on principal. And a year into the loan, out of that $1,200, just over $200 of it was going to principal. Nearly $1,000 of that $1,200 was going to interest. I was shocked. So, in the first 7.5 years of your mortgage, how much of your payment is going to interest? 80%. Let's talk about cars. I have a friend who worked in the car business for 17 years, and when I showed him the research I was doing, he said, Rod, I find that hard to believe because it's not what we were seeing in the car industry. I told him that people could get a 6% car loan, and he said, well, yes, maybe if they have perfect credit. He said, but most people don't have perfect credit. Unless your score is somewhere around 720 or 730, you're not going to get a 6% car loan. He said, we were writing loans for 15%, 17%, 20%, 22%. And so the worse your credit is, the higher your interest is going to be. So the point I'm trying to make here is the number I'm going to give you is a best case scenario. Now, we also need to understand that there's a difference between interest rate and interest volume. The interest rate is what it says on your agreement with the bank or the credit card company. So that might be 3.5% on your mortgage. It might be 6% on your car loan. It might be 15% on your credit card. But the volume of interest is how much interest you pay over time. And when it comes to your house, that's 80% in that first 7.5 years. When it comes to your cars, that's 14%. Even though you might get a 6% interest rate, the volume is going to be 14%. Credit cards, again, the volume or the portion of your credit card payment that goes to interest, 42%. So when we put this all together, 34.5% of our take-home pay goes to interest charges. Folks, this is the take-home. This is after Uncle Sam gets his cut. What's left after you pay your taxes, for most of us, 34.5% is going to just paying the interest on your loans. So what does it look like when we put it all together? What is the impact of taxes and interest on our income? Well, let's say that you make $100 an hour at your job or business. I hope you make at least that. We know that Uncle Sam is going to get 40%, right? So that's $40. That means you have $60 left. And then how much in interest do you pay? Another 34.5%, that's almost $21. And the total impact of taxes and interest on your income is 61%. I don't know about you, but I'm not satisfied giving away 61% of the money I earn. I work way too hard for it. Is it any wonder we have only pennies in our savings bucket? It's because taxes and interest payments are killing us. They're taking most of our money, and we just sit back and take it, don't we? Because we don't know that there's a better way. Now, remember that video I showed you? If we need to, we can go back to that, and you can watch that antelope run into that tree one more time. Because I want you to see what's happening to us and we don't even think about it. Now, I hope that this gets under your skin. I hope this makes you a little bit angry, because it should. And once you arm yourself with information, once you educate yourself, once you change the way you think, then you can begin to change your behaviors, and when you change your behaviors, you can change your outcomes. Let's take a look at the savings rate in our country. Isn't it interesting that the savings rate here, as we look from about 1959 through about 2009, isn't it interesting that the savings rate in our country has declined as credit has become easily available? You can see that we peaked here in the 1970s at 14.6%. As a country, as a nation, we were saving 14.6% of everything we earn. But even though there's been ups and downs in the rate of savings, we can see an overall trend that has coincided with the availability of easy credit. Folks, we're just giving our money away. I want to point out here that you see a 6% spike around 2009, and what that has to do with is an artificial momentary increase, a spike in the savings rate that is attributable to the money market. And here's the explanation for that. In October 2008, we had the stock market dive and we had that extended recession. Well, according to economists, what happened is people pulled their money out of the market because they were afraid. They saw what was happening to their 401ks. They pulled their money out of the market, put those funds into a money market account, which was safe. It was only earning about 0.25% or 0.1% of interest, but at least they weren't losing anything. So people parked their money there for several months, waiting out the recession, waiting for the stock market to stop rumbling. And so when that savings rate was measured, all of those money market funds were counted into that savings rate, and that gave us that artificial spike of 6%. So the reality is we do not save money, and we're on a downward trend, and that's what's happening in our society when it comes to saving money and being good stewards of what we have. There probably isn't one of us listening today who could have predicted that recession that we had. And on this graph here, you will see it. See this thin band here that's sort of a darker green or olive color? That is the recession that we had that began sometime around late 2008, and according to economists, lasted several months and was over, I believe, sometime in 2009 or 2010. Of course, we're still feeling the effects of it, but technically it was over after a several-month period. Now, none of us probably saw that coming. Yes, there are some experts, now that we look at history, there were some people who were saying, hey, this housing market bubble is going to burst, it's going to be disastrous, watch out. There were some people who were actually warning against this, but by and large, in our country, around the world even, we didn't see this coming. Here's the point I want to make. If you look back in history, we have had several recessions throughout the last several decades. Every one of these bands of that olive color represent recessions in the U.S. We had the dot-com bubble burst right after this millennium started, the savings and loan crisis in the early 1990s, the oil embargo under the Carter administration, Cuban Missile Crisis under the JFK administration, World War II, all the way back to the Great Depression. You can see that periodically we have a recession. Now the stock market has gone up and down, and has trended pretty much upward, but we know that in the last few years it has not, and only recently has begun to recover. But again, the point is we've had several recessions throughout history. And if we've had several throughout history, do you think we're going to have another one? The answer, yes. It's bound to happen. What happened in 2008 was not an anomaly. We're going to see another recession in our lifetime, and we need to be aware of history so that we can have an eye on what's coming in the future. There was a study conducted by the Center for Retirement Research at Boston College, and here's what they found. Baby boomers and Generation Xers will be retiring in a substantially different environment than did their parents. If you're a baby boomer, you were born between 1946 and 1964. After the war, the soldiers came home, the economy started to boom, and what followed was a baby boom. We were building highways, we were moving out into the suburbs. It was a very affluent time, a time of growth in our country, and with that came the ability to have more kids and to afford a bigger family. We saw a huge spike in the number of births between 46 and 64, and so that generation is called the baby boomers. They were followed by the Gen Xers, who were born from 1965 for about the next 17 or 18 years, And here's what we know according to this study done by Boston College. For the first time in our country's history, our children are not going to retire as well off as their parents did. That has never happened before in the history of America, but it's going to happen now. The baby boomers and Gen Xers will be retiring in a worse state than did their parents. 51% of U.S. households are at risk of being unable to maintain their standard of living upon retirement. And here's the worst part of it. We weren't prepared even before the economic crisis. Had there not been the stock market dip in 2008 and the recession that followed, we weren't prepared even prior to that happening. That just made it worse. We need to do two things. It's time to make a change. Number one, we need to change the order of our buckets. We've got to save first. Two, we need a coach. Just moving the buckets isn't enough. We need a coach who has the best strategy. As I explained at the beginning of this presentation, I'm in marketing. I love to do that. I love to tell stories. I love to get to know people. I love to help them take their concept and share it with the world. I'm not a finance guy. I'm not into numbers. I don't understand strategy when it comes to an investment. But you know what? I don't have to. All I need is a coach who can understand that for me, who can shepherd me, who can guide me, who can advise me. What the right coach can do is show you how to take your savings bucket and use it to shrink your taxes and your expenses bucket. Watch what happens here to your taxes bucket and your expenses bucket. By using the right savings vehicle, you can shrink your taxes bucket and you can shrink your expenses bucket. And what happens when you shrink the bucket? When the bucket gets smaller, less has to go into it, right? The smaller the bucket, the quicker it fills up. So, isn't it not in your best interest to try to shrink your taxes bucket and shrink your expenses bucket? And you can do that with the right savings vehicle. Folks, if you can understand the concept on this slide, you're going to be able to understand most of what we're showing you today. It's a simple concept. Find the right savings vehicle to shrink the amount of taxes you're paying and shrink the amount of expenses you're paying. That's it. So, you are going to learn how to become your own banker. Everyone should be in two businesses, whatever they do for a living and the banking business. Now, by the banking business, we're not saying you should go out and try to get a bank charter and spend millions of dollars on getting that charter and getting a bank building and hiring employees and buying a safe and all of that. That's not what we're saying. What we're saying is your personal finances, your household, should be run as a bank. So whatever you do for a living, do it because you're good at it, because you have a passion for it, because you can make money at it. But you also need to be in the business of running your household like a bank. We need to understand something called lost opportunity cost. You know, we finance everything we buy. Either we pay interest to someone else and use their money, or we pay cash for something and we lose interest we could have earned. Let me say that again. We finance everything we buy. Either we use someone else's money and we pay them interest for that privilege, or we use our own money, we pay cash, and then we lose interest because that money's not being invested. So, lost opportunity cost is the interest we didn't earn because we used our money instead of keeping it invested. When we make a choice between two things, that choice has a cost. We lose the opportunity to do the thing we didn't choose. By listening to this presentation today, you lost the opportunity to do something else with your time. But we trust that that was a great investment. Let's take a look at purchasing a car, and we're going to look at side by side 4 different methods of purchasing a car. We're going to show you what it costs to lease a car. We're going to show you what it costs to get a bank loan. We're going to show you what it costs if you use your own money. And then we're going to show you what it costs with the concept you're learning about today called Infinite Wealth Banking. Now, we're going to purchase 7 cars over a 28-year period. So every 4 years, we're purchasing a new vehicle. And we're going to say that this is a $20,000 vehicle. So let's refer to it as a Ford Taurus. All right, if you are to lease your Ford Taurus, you can expect to pay about $116,000 in lease payments over 28 years. Now, the LOC that you see on the next line is the lost opportunity cost. What is that $49,000? That $49,000 is the interest you did not earn because you spent that $116,000 on a car. If you get a loan from the bank, you can expect to pay about $105,000 for those 7 cars. Your lost opportunity cost is less, and so you are spending $131,000. That's your total realized cost. Now, our parents taught us to pay cash for things, right? They said that's always the wisest thing to do. Pay cash when you can. And if you were to do that, your out-of-pocket would be $93,450 for those cars. You would have a lost opportunity cost, but it would be much lower. Now, we're assuming that what you would do is take money out of the bank to pay cash for your car, and then every month you would put the equivalent of that car payment back into your savings account. That is why your lost opportunity cost is much, much lower. Now, our infinite wealth banking concept. You do initially have to pay for those cars. And we're suggesting that you charge yourself a rate of 10% interest. That's why you see that $113,000 figure, and that's why it's higher than paying cash or getting a bank loan. It's because we recommend you pay yourself 10% interest. Can you pay yourself 9% or 8%, 7% interest? Sure you can. That will lower your car payment. That will make that number smaller. But since you own the bank in this case, we'll explain more about that later, but in this case you own the bank, so why not charge yourself more interest if you can? Now here's the beauty of this. There is no lost opportunity cost. Because you own the bank, this is your money that you already have, and you're constantly reinvesting it. What makes it better than paying cash is because there are many more things going on in this concept than just earning interest. Now, here's the thing that is a little difficult for people to understand, and at this point, this is where mentally a lot of you will probably fold your arms and look down your nose and say, I don't believe that can be true. But here's what we're telling you today, that after you pay cash for those cars out of the bank account that you own, you will wind up with a positive balance in that account of $177,000. Yes, what we're telling you once again is you can use your own money from a bank that you own, purchase 7 cars over a 28-year period, get every bit of that $113,000 back, and on top of that, have a balance of $177,000. If that seems hard to believe, just remember what Maxwell said. If you are too attached to your own thinking and how everything is done now, then nothing will change for the better. Does this seem impossible? Yes, based on what we've been taught by the world about money, it does seem impossible. It doesn't make sense. But remember, we made a pledge to be willing to unlearn some of the things we've been taught about money. So how does this work? Well, you're probably pretty curious by now, and here's the answer. We do it by utilizing dividend-paying whole life insurance. We are going to teach you to look at life insurance in a whole new way. You are going to borrow from the cash values in your policy. You are going to earn dividends and interest. You are going to have an ever-increasing death benefit. You are going to take loans and repay yourself and accumulate wealth on a tax-free basis. Yes, we did say tax-free. If the only thing you're interested in today is reducing your taxes so that you can continue to grow wealth, this is a great way to do it. Let's take a look at how banks work. If you're going to be a banker, I guess you should know how banks work, right? What do banks do with our money? Well, they take our deposits and they make loans. And when those loans get repaid, the bank makes money. Banks also invest in mortgages. And when those mortgages get repaid every month, the bank makes money. Banks also invest in joint ventures, shopping malls, office buildings, construction projects. Banks invest in those, they finance them, and when those are complete, the bank makes money off that investment. Where do banks pay out on the other side? Well, they pay interest to account holders. They also have a cost of operations. They have to pay their employees, pay their utilities, their building costs, equipment, etc. I didn't know this. Insurance companies work just like a bank. Insurance companies also have a pool of money. But where does their money come from? It comes from the premiums that are paid on an annual basis. And when you pay your insurance premium, does the insurance company take it and just hold on to it and put it in a vault somewhere and wait for someone to die and then pay out a claim? Obviously not. If they did that, they'd go bankrupt. They have to invest that money somewhere so that they can earn money to pay out the death claims. So, what do? They invest in mortgages, and when those mortgages get repaid, just like a bank, the insurance company makes money. They also invest in joint ventures, shopping centers, construction projects, and when those pay off, the banks make money. They pay out interest as well, but they also pay dividends if the insurance company has a good year. They also have a cost of operations. They have to pay their staff, utility bills, building costs, equipment, etc. And then the other place that insurance companies pay out, this is the big one, of course, that we all understand, and that's death claims. Now, there's one other place where insurance companies loan money, and that is to you, the policyholder. Your whole life policy has a cash value. Just like the insurance company has a large pool of money, your individual policy has a pool of money inside it as well. And that's what you borrow from. And here's the great thing. Out of all of the places that the insurance company loans money or invests money, the one that trumps the other two is the cash value and policy loans that are made against it. Here's what this means. If you want to take a loan from the cash value in your insurance policy, all you have to do is call your agent and you can get that loan. They're not going to say to you, oh gosh, I'm sorry, but the cash value of your policy is already invested somewhere and we can't loan it to you. They're not going to do that. They can't. They have to make it available to you. Now, here's the beauty of this. You use your insurance policy as a banking vehicle. Insurance companies and banks work the same, right? That's what we just showed you. So you use your policy as a banking vehicle. And here's how you do that. You take a loan and you repay it. You take a loan and you repay it. And if you understand the concept of weightlifting, what happens when you exercise a muscle? The more you use a muscle, the larger it gets, right? Well, watch what happens to the cash value of your policy, the dividends and interest you're earning, and the death claim associated with your policy. Watch what happens to each of these as you take loans and repay them. Take loans and repay them. They get huge. And they grow at a tax-free rate. Do your current investments do all of this? No, they do not. Other investments earn either interest or dividends, but not both. Life insurance is a gross misclassification. It really is a personal banking system with a built-in death benefit. We're asking you to think about life insurance in a whole new way. Typically, the way we think of life insurance is it solves the problem of, what if something happens to me, I die unexpectedly, how will my family be taken care of? And so we focus on the death benefit, but during your lifetime, your need for finance will be much greater than your need for a death benefit. What happens between the time you first buy your policy and the time you die? Hopefully, you live a very long time. And isn't it beautiful that we have a vehicle through life insurance that can not only take care of your family if something happens to you, but it can also finance your life. Okay, let's take a look under the hood, if you will, at a life insurance policy, and this is for a male, age 40, non-smoker. Now, I want to point out the different parts of the insurance policy here. You can see that in this column we have the progression of time. In this column we have the policyholder's age at the end of that year. Here we have the annual premium that's being paid. If there is a loan, the amount and the year that the loan is taken is shown here. When the loan is repaid, that is shown here. And these are the three parts of the policy that you want to be most concerned with. These are the ones that grow: the annual dividend, the cash value, and the death benefit. The annual premium for this illustration is $5,040. Can your premium be lower? Sure. If you can't afford that, if it's not within your budget, you can have a lower premium. That means you'll have a smaller death benefit. Can your premium be higher? Sure. If you can afford to invest more than this into this policy, you can have a higher premium. And we can see at the end of the first year, you have put $5,000 into this policy. You have an annual dividend of $51, a cash value of $3,200, and a death benefit of $135,000. Now keep an eye on the cash value, because that's where we borrow from. That's the pool of money. That's your bank account that exists within the policy, and that's where we take our loans. After year 2, you've got almost $7,300 in cash value. After year 3, you're continuing to pay your premium every year. You've got almost $13,000 in cash value. And then at year 4, you've got $18,648. So what happens in year 5? We can see that we take our first car loan. Now why is the amount $13,350? Remember, in that illustration we showed you before, we said we were buying a $20,000 vehicle, a Ford Taurus. Well, we are assuming that you're trading in a 4-year-old car and that you are going to get a great trade-in price. And so by the time you pay cash and pay your title and taxes, your out-of-pocket is going to be $13,350, and that's what you are going to borrow. So, congratulations, you've purchased your first car. You made a phone call, said, hey, I need to make a loan from my account. You got the check, it was sent to you, you went down to the auto dealership, you paid cash for your car. Now, something happened prior to that, and that's called capitalization. Remember, your goal in this case was to pay cash for a car. You couldn't do that at the end of the first year because you only had $3,241 in cash value. So you waited and continued to build that cash value. This is called the capitalization period for your banking business. Now, it doesn't have to be 4 years. If your goal was to only buy books for your child's first semester in college, that $3,200 certainly would have been more than enough. You could have taken a loan right away. But in this case, you wanted to buy a car, so you were patient, you capitalized your bank, and now you paid cash for your car. Here's the loan repayment. You can see that you are repaying the loan every month, and over the course of 12 months, that amounts to $4,056 per year. And 4 years later, we trade in that Ford Taurus and we get another one, another loan in year 9. And then moving on to page 2 of this illustration, you can see that we're taking a loan every 4 years and we are repaying it as we take the loan. So the bottom line is you invested $121,000 in premiums. You invested $81,000 in car payments for a total of $202,000 that you put into this policy. That's what you paid for your insurance premiums and your car payments. And look how much cash you have. You have more cash than you invested in the policy through the premiums and the car payments. So you got all of your premiums back, and your car payments actually came back to you as well. So the cars cost you nothing. How did this happen? Because of the growth that's going on in the cash value of the policy. Remember the concept of exercising a muscle. The more you use it, the bigger it gets. So as you took these loans through your policy and you paid them back and paid yourself interest, your cash value continued to grow, and it far outpaced what you paid for the cars and the premiums that you put into the policy as well. And incidentally, if anything happens to you, your family is well taken care of through a strong death benefit. I want to go back now to that illustration where we purchased a car using 4 different methods, and we put them all side by side. And as you recall, I said that using infinite wealth banking, not only would you get all of your car payments back, but after the end of a 28-year period, purchasing those 7 cars, you would have a positive cash balance of $177,000. And we said, that just doesn't seem possible. How can that be true? It goes against conventional wisdom and everything we've ever learned about money. But as you can see through the illustration we just showed you, you can use a life insurance policy with a built-in pool of cash. We borrow from the cash values, pay ourselves back, and over time we build wealth systematically and securely. You can quick start your bank. What does that mean? Well, you can convert some other investments, or let's say you inherit some money and you want to use that to capitalize your bank, and you don't want to have to wait to start using the money. Once the bank is capitalized, the premiums will be paid by the cash values within the policy. And here's the nice thing about that. At this point, your annual cash outlay will be 0. You don't have to keep paying a premium year after year after year. Now let's look at this again in the context of a life insurance policy. We see that the annual premium stops after 8 years. Actually, it doesn't stop. Starting down here in year 9, it does continue. You see zeros here, but that indicates that you are not paying the premium out of your pocket. The premium is being paid by all of the growth that's going on over here between the annual dividend and the cash value. As you can see, you could finance a car in year 2. Put more money in initially, capitalization period gets reduced. How about down here in year 8? You've stopped putting money into it, and now you've got a cash value of $72,000. That's enough to pay most families' expenses for an entire year. What would happen if you put your groceries, utility bills, car payments, mortgage payment? What if you put every one of your expenses through the bank? Imagine how big it would get. How about down here in year 11? You can pay off your mortgage, make monthly payments to yourself instead of the bank, and save $75,000 to $100,000 in future interest. So you've put not even $70,000 into this, and you've got a cash value of almost $404,000. Not to mention a death benefit that's over $680,000. And notice there's no loan activity on this policy. Imagine how much bigger these numbers get if we would have shown loans on here. So, how do you start? Again, with any business, there is a capitalization or a startup period. Your banking business is no different. That startup phase may take some time, or it can be very short, according to your ability to fund your bank. You can start immediately if you want to convert some of your other investments. The easiest place for most people to start is with a car or maybe some of their monthly living expenses. Let's take a look at where we traditionally invest our money. We tend to put it in things like IRAs, 401ks, self-employment plans, but we need to remember that these are qualified accounts and we're not allowed to use them until we're at least 59 and a half years old. If we use them sooner than that, we have to pay a penalty. And even when we do use them, when we're 59 and a half or older, who comes to visit? Uncle Sam, right? The IRS is going to take its cut. We also invest in stocks, bonds, mutual funds, but we know that that can be a roller coaster. It's up and then it's down. It's up and then it's down. And then, of course, who comes to visit? Again, Uncle Sam. We put our money in things like term life insurance and disability insurance, but we need to understand that while those are good, they also have their limitations. For example, term life insurance has no cash value. Remember, what we're showing you today is whole life insurance, dividend-paying whole life insurance. Term life insurance does not have any cash value. There's nothing to borrow from. Plus, the cost increases as you get older. If you were to buy a term life insurance policy today, they would give you a physical, they would assess your overall state of health, look at your medical history and say, okay, this is how much we're going to charge you for this amount of coverage, say $250,000 of death benefit. And for 10 years, that's what you would pay. Every year your premium would be the same and your death benefit would be the same. After 10 years, that contract is up and they're going to say, okay, you're 10 years older. The chances of you dying are much greater than they were 10 years ago. So for that same $250,000 of death benefit, your premium now is going to be this much and it's going to be higher. So the cost increases as you get older. Not only does the cost increase, but the value decreases. Remember that in term life insurance, the death benefit does not increase. It stays the same. With whole life, you've got that death benefit that's increasing every year, but it stays stagnant when you have a term life policy. So as you put more money into your policy, you pay the premium, then you pay the premium the following year, then you pay the premium the year after that. The more money you put into the policy, the less your net return is. The payout at the end is not getting greater, but you're putting money into it every year. So the longer you pay into it, the value is going down. Most of us probably don't realize, but a lot of money flows through our household, through our hands in our lifetime. For the average family, it's about $2 million during your wage earning years. That's how much flows through your hands. And let's take a look one more time at those buckets. When we invest in the stock market, which bucket does that affect? It affects the savings bucket, right? It has no impact on reducing your taxes or reducing your expenses. Shouldn't we direct at least some of our efforts at the rest? That's what infinite wealth banking can do. It not only helps you save money, it reduces your taxes and your expenses. You might be thinking, well, Rod, that's all really good, but I still like the market better. Well, let's take a look at those two side by side. Which one gives you a guaranteed rate of return? Certainly not the market, but infinite wealth banking does. You are going to get a guaranteed minimum return on your life insurance policy. Which one is liquid? You can't use most of your funds invested in the market until you're 59 and a half. You can get a loan from your policy anytime you want it. Which one's tax-free? We've already covered that. Which one has a death benefit? That one's pretty easy. Which one has an overall better rate of return? Well, let's give that to the stock market. If you look at the history of the stock market, despite its ups and downs, you're going to see that it returns somewhere, on average, between 8 and 11%. But, you know, this is not necessarily an either or. I don't think anyone's going to say you shouldn't invest in the market. Why not have a position in both? Have infinite wealth banking and also invest in the market. And remember, this is a banking process, not an investment process. We're not just growing wealth, we're financing our everyday life. Having an investment in the market is great, but unless you've got it in something like real estate or something that's a high yield that's kicking off income every year, it's not paying for your needs today. We live in a cash flow world, not an asset world. And again, why not do both? What if we would just change the way we think? I want to show you another short video. It's a man and a woman, an exchange between the two, and I want you to listen to what they say because it illustrates, again, a very important point.
Hi.
Hi.
I was marooned on an island for 5 years with this package, and I swore that I would deliver it to you because I work for FedEx.
That's very admirable. Thank you.
Hey, but by the way, what's in the package?
Nothing really. Just a satellite phone, GPS locator, fishing rod, water purifier, and some seeds. Just silly stuff. Thank you again. You keep up the good work.
Oh, that poor guy. He could have been off that island much sooner if he would have just used his head, common sense, and looked inside the package. But he didn't. Why? Because he said it. I swore I would deliver this package because I work for FedEx. What did he do? Exactly what he had been taught. He didn't change the way he thought about things. He didn't think, gosh, maybe there's something inside this package that can help me. No, he did what he was taught to do and never even thought twice about it. And of course, what does she say to him? He's standing there crushed, and she essentially makes fun of him. Thank you so much. You keep up the good work. And isn't that exactly what the banks and the finance companies would say to you and me? You keep up the good work. You're doing fine. You're doing great. Meanwhile, we're that antelope out there running into the tree, the only tree that's out there on the Serengeti, knocking ourselves out and letting the lions devour us. Well, it doesn't have to be that way. I want to show you one more illustration, and this is the typical American. I think when you see this, you'll agree with me that this is pretty much true. This is the way we learn to manage and think about money as we're growing up. Think back to the time when you got your first job. It might have been around the time you were 10 years old. I had a paper route, and then I was a caddy at a country club, and it was great because I'm making a little bit of money and it's mine, and I can do with it what I want. And I never really learned to save any of it. I tended to spend every bit of that money that I made. I'm living at home. My mom and dad, of course, are caring for all my needs. So I'm out there buying bubble gum and baseball cards and soda pop and stuff like that. And I pretty much spent everything that I made. But then what happens? We graduate from high school, we go to college or a trade school, or we get right into our profession, and we get that first big job. And wow, we've arrived. We're making a full-time income. We're living on our own. Probably we've got an apartment. Maybe we've bought our first new car. We're buying our own clothes. And so again, our expenses tend to rise to the level of our income. Not only that, but now we're taking on debt in the form of a car payment. Maybe we've got student loans. And so really we've got no money in our savings, and now we've got debt because we've got monthly installments. And then we get to be middle age and we haven't saved anything. You know, the average 50-year-old has saved only about $25,000 or less, and that includes the equity in their home. Wow, people, we're not saving money. But we get that big pay raise, and so now we can afford a bigger house, and now we can afford the boat. We can join the country club. We can do all these things because we've got the money to do it, and we keep accumulating more and more debt, and we don't ever save. And that's why when we get to be age 65, we can't stop working because we've got to finance this life we've built, and we've got all this debt, and we've not saved anything. Our savings bucket is empty. Isn't that how the typical American behaves today? Because that's their thought process, and our thought process drives our behaviors, and our behaviors determine our outcomes. We need to break ourselves free of this cycle. We need to do two things. I'm going to go back to that slide where we showed you the buckets. Number one, we need to change the order of our buckets. Folks, we need to start saving first. Pay yourself first. And second, we need a coach. We need a coach who has the best strategy. We need a coach who can show us how to take our savings bucket and shrink our taxes and our expenses bucket. I want to leave you with that on your mind. Thank you very much for joining us for this presentation of Infinite Wealth Banking. We hope that it's been a blessing to you. It's certainly been our privilege to bring it to you, and we wish you the best. God bless you.